The stock market sent out a really weird, kind of contradictory signal last week. So, in this explainer, we're going to put on our detective hats, follow the clues, and figure out what the market is really trying to tell us.
So let's start with the puzzle. Because on the surface, what happened in the markets last week? Well, it just doesn't make a whole lot of sense. It's kind of like seeing the sun come out and the temperature dropping at the exact same time.
And here's the heart of that contradiction. The S&P 500, it had a good week. Now, normally when stocks are climbing, you'd expect investor fear to go down, right? But it didn't. It actually went up. So, what is going on here? Okay, look at the numbers. The S&P 500 rallied 0.7%. But at the same time, the VIX index, the market's fear index, it rose by a full point. This is basically the opposite of what's supposed to happen. These two usually work like a seesaw. When one goes up, the other goes down. The fact that they both went up together, that's our first big clue that something pretty unusual is happening under the surface. To solve this thing, we first have to get on the same page about what the market really means when it talks about fear. Because it's not actually about what just happened, it's a forecast for what might be coming next. So the VIX measures something called implied volatility. The best way to think about it is like the market's weather forecast for the next 30 days. If the VIX is high, the forecast is calling for storms, for choppy seas. If the VIX is low, it's expecting clear skies. And last week, well, that forecast just got a little bit stormier.
But look, a forecast is just a guess, right? It's a prediction. There's also the actual weather that hits, and in market speak, that's called realized volatility. It measures how much the market actually did bounce around. It's the reality, not just the expectation.
And this right here, this solves our first puzzle. What happened was the market's actual turbulence, that realized volatility, it jumped and jumped significantly last week. The forecast, our VIX index, was really just playing catch-up. It didn't rise because investors were suddenly more afraid of the future, but because the present turned out to be way choppier than anyone expected. The forecast was just adjusting to reality. Okay, so with that first clue sorted out, we can move on to the next piece of the puzzle. And trust me, this is a big one. It has to do with a huge shift in how investors are protecting themselves, or maybe more accurately, how they just stopped protecting themselves. Now, to get this, we need to talk about something called skew. Honestly, the easiest way to think about skew is just as the price of crash insurance for your stocks. When a lot of investors are getting worried and they're all rushing out to buy protection, the price of that insurance, it goes way, way up. Now, get this. Just 3 weeks ago, the price of that crash insurance was at a record high. It was sitting in the 99th percentile of its entire history. That means people were paying absolute top dollar to protect themselves. And you could feel the worry in the market. And then, all of a sudden, the floor just fell out. In just a couple of weeks, the price of that exact same insurance collapsed. It went from the 99th percentile all the way down to a historic low in the 6th. The market went from extreme caution to almost zero concern, like overnight. Now, the price has bounced back a little since then. It's kind of settled near the historical average, around the 48th percentile. But don't let that fool you. That massive swing from 99 down to 6, that's the real story here. So what on earth could cause a crash like that in the price of protection? The source material we're looking at gives us the answer in 2 perfect words. Hedgers capitulated. I mean, that's such a powerful phrase. It means the people who were buying all that expensive insurance, they just gave up. They threw in the towel. They stopped buying protection, and that is what caused the price to absolutely collapse. So you have to ask yourself, right? If investors aren't spending money on a safety net, where's all that money going? Well, the clues are all pointing toward a major shift in thinking, which brings us to our next piece of evidence. It's a simple idea, but it's really powerful. If you decide to cancel your insurance policy against a market crash, it's probably because you're not worried about a crash anymore. In fact, you're probably getting pretty excited about the chance for a big move up. And we can actually see this happening in the data. There's this signal, it sounds a little technical, called inverted call skew, but all it is a classic sign of FOMO, the fear of missing out. It happens when investors get so excited about the upside that they start paying more for these long-shot, lottery ticket-style bets that a stock will just skyrocket. They'll pay more for that than for safer bets on a smaller rally. And this behavior is just surging right now. Historically, only about 3% of the top 100 stocks show this kind of signal. Right now, that number has jumped to nearly 20%. That's a huge wave of optimism sweeping through the market. Now, for a little context, We're not quite at the frantic, crazy levels of the 2021 meme stock frenzy, but sentiment is, without a doubt, extremely high. It's signaling a really powerful belief among investors that we're heading for a strong rally to close out the year. Okay, we've gathered all our clues. We figured out the puzzle of the rising VIX. We saw the safety net completely collapse, and we found where all that money went. So now let's put it all together and finally reveal the market's hidden message.
So here's the full story. That strange signal, stocks and fear rising together, it was just a blip. It was a reaction to the market being choppier than expected. The real story is the complete U-turn from investors. They have abandoned their defensive plays and are now betting aggressively on more upside. The market's hidden message is one of just overwhelming optimism.
And that brings us to our final kind of provocative thought. When the market gets this one-sided, when pretty much everyone has canceled their insurance to bet on the very same outcome, it leaves a really critical question. With optimism this high, what is the one thing that absolutely nobody is prepared for?